following is a technical analysis on TLT, the largest component to the US 20-year displayed throughout the much larger picture. Call it the macro lens of the monthly interval. And we are within a descending primary triangle and or bullish falling wedge where the price is compressing between a long-term, call it a long-term descending price resistance level of a multi-decade price support level at the 82.59 handle. And that is big reaction amongst that key inflection point off the 2006 major reactionary lows there. We have confirmed bullish divergence in multiple indicators, showcasing classic divergence with price making lower lows, with the relative strength index on a confirmed positive divergence. You have the moving average confirmed price percent oscillator, momentum oscillator with huge divergence, and the stochastics that are making higher highs and a potential bear trend exhaustion signature trade. And that is positively confirmed there on all. Called it a triple divergence key inflection point, and that is very bullish if yields peak and rate cuts are anticipated. This is an excellent triple divergence, strong structure tightening wedge pattern, and it will take macro yields to spike higher unexpectedly or inflation reaccelerating for an additional breakdown. You have a minor reactionary uptrend price support level in confluence of a beautiful, well-defined dragonfly candle close setup, and that is as really one of the best looking monthly price interval candles that I've seen in quite some time, reflecting the nature of a bullish key candle. With the relative strength index around the 39.64 handle, it has clearly seemed to have bottomed and turned higher, helping form that triple divergence off of 2022. The moving average convergence is sloping bullishly toward the zero line from deep lows here off the deepest since its inception of time off the 2006 major reactionary lows here. That is a form of positive divergence and beginning to churn higher towards that zero line threshold that the moving average traders would need to confirm and reclaim to spur additional health back into these key technical momentum indicators. Although the oscillator histogram is still negative but shrinking fast, which could indicate additional reversal signs to cope on a much larger move to the upside. Biggest telling key inflection point bar none is the stochastics custom 1033 indicator here, and each and every time it has risen back above the basement, it has had strong historical signal zones here. As soon as we reclaim that key inflection point, that was off to the races for a 47% move to the upside, negated just shy of hitting down below that key inflection point, call it the 1960 handle right below the basement, back tested it twice. Once again, we reclaimed back from the basement here, ultimately issuing in a multi-structural 36% in gains of the upside. Near the 2018, you had a huge rally for 59% in gains of the upside. Ultimately, the Fed going all in 2020. Again, reverted back to its mean here off the lows, recircling back into that 1960 handle. That was good for, call it 17% in gains. You get the picture. Just very strong historical reaction throughout this span of time, and it has been lifted off once again and back tested it off that 19 handle. Divergences are stacked. Support is just bar none historic here on a multi-decade price zone and price demand zone, and this could mark the beginning of a multi-year bond rally. This is one of the most structurally beautiful descending wedges on a monthly macro scale. The price is just coiling. This is not just a technical key inflection point. This is a big macro inflection point. Taking you out to UBT, a 3x lever of the US 20-year Treasury bond. And we are within, just by the skin of its teeth, a divergent low with positive and bullish divergences located amongst all key technical momentum indicators with massive volume spikes around this key region here on the daily. Much near-term pictures looks like it has backtested. We are within a zone, call it a primary trading range, and this is a big inflection point with potential bullish structure. You take away all the lines here, and you could very well be be within the beginning stages of an inverse head and shoulder classic looking bottom, ultimately constructing the last ends of its right shoulder formation pattern, and watch for its break of its neckline, which will be very highly correlated with its 200-day moving average. And that could enter a very telling move to the upside with this massive volume spike and huge volume profile around this key range, showing the vast majority of the masses piling in and backing its biggest macro inflection monthly point in its all-time inception. With the additional storm clouds of a potential recession gathering, with yield curves remaining which were deeply inverted, disinflationary forces are silently reclaiming its ground with a drop in CPI, drop in producer price index prices, and as liquidity tightens and economic momentum stalls, the bond market could whisper what equities refuse to hear, that the pivot is no longer a matter of if, but when. And when central banks demand relief from its ultimate debt machine, and when the Fed finally blinks, the long end in TLT won't just rally, it could completely explode. In a world addicted to leverage, duration becomes the sanctuary, with a macro backdrop, cooling inflation, and a weakening labor data, and a fractured global economy could scream one message: that bonds are back, and TLT may not just be a hedge, it could be a new trade for this entire cycle.